Okay, so I just needed to finish up a couple of things here. My laptop is all powered up again, so we should be good. So anyway, I left off talking. Let me just do a quick summary of what all this stuff was. All right, and I'm going to draw two economies, and let's see. Let's make one of them. This is going to be the long run. Let me do the dotted line. Just keep things consistent. All right, so we're going to pretend this is our long run aggregate supply. So that tells us where full employment is. All right, so long run aggregate supply. And so we'll say this is short run aggregate supply. And here's aggregate demand. And so remember, if we're to the right of this, if we're to the right of the full employment amount, then typically we would say that there's most likely we're going to have some level of inflation. All right, price level there, P1 there. So here's one scenario. All right, and then the other scenario is here's aggregate demand and short run aggregate supply. And let's draw this here. So here's our full employment, our potential output along the long run aggregate supply curve. And if we're to the left of it, then this would be a recession. Okay? And so the Federal Reserve has, remember those three macroeconomic objectives of, let me write in a different color here. They want full employment, price stability, and economic growth. All right? And so if you remember, let me draw this in again. This is C plus I plus G plus NX. And same over here. C plus I plus G plus NX. And so monetary policy, the Federal Reserve controls the money supply. And money supply. And so here's how they do it. If we are in a recession, all right, then they are going to want to do, and make sure you write these down, they're going to want to do something called expansionary monetary policy. All right, this is what they've been doing for a few years now. So the idea is, remember, we don't, if we're in a recession, economic growth and full employment are having some issues, and so they say, how can we cause this to go up? And so remember, the Federal Reserve controls, for the most part, interest rates. All right, it's all about interest rates. Okay, a lot of the macroeconomy boils down to interest rates. It's not the end all be all, but it's a big deal. So if the Federal Reserve can control the interest rates, then they can encourage consumers and businesses to either borrow more and spend more, or to borrow less and spend less. All right, and so if we're in a recession, remember, we want consumers to spend more and we want businesses to spend, we want all these numbers going up generally to kick us out of the recession. And so how can the Federal Reserve cause the consumers to spend more and businesses to spend more? And so if they increase the money supply, then they can cause interest rates to go down. All right, and how can they, and when interest rates go down, consumers are more willing to buy cars and washers and dryers, anything on credit, as well as houses. Businesses are more likely to build factories, buy machinery, all that kind of stuff. So we talked about the tools of monetary policy, and so we need to look at, under an expansionary policy, what are the three ways the Fed can achieve this? All right, because that's the goal, go into AD2. And so with reserve requirements, they could, remember, we want more money in the system, more excess reserves. So with the reserve requirement, we would lower it, all right, because that would create more excess reserves. For the discount rate, remember, that's the rate that the Fed charges the banks to borrow money. So if you want to encourage banks to borrow money from the Fed and in turn lend it to customers like you and I and businesses, then you would lower the discount rate. And what about securities? And remember, securities is just a fancy way of saying buying and selling bonds and other government financial instruments, I guess. Uh, so securities, would you want the Fed to buy Treasury bonds, or would you want them to sell Treasury bonds? All right, and so going back over here, open market operations. If remember, this is the bank's vault. Cross that out. Here's the bonds. Here's the cash. If you want to lower the interest rate, you're going to want to increase the amount of cash, and so the Fed would buy back the bonds and give the bank cash, and that would put more money in the system. And so when we're talking about the tools for a recession, they would want to buy securities. All right? And hopefully all these things would have the effect of increasing the money supply, which would cause a decrease in interest rates. All right, and so that's how the whole thing works. All right, this is the essence of monetary policy. All right, now, what about inflation? We would have, and by the way, also note this, expansionary policy can be called loose monetary policy. Uh, and there was one other that's not coming to mind. So you might see that in a couple of different forms, expansionary monetary or loose monetary. They all mean the same thing. All right, so what if we have inflation? We want aggregate demand to come down, all right, to there. And so remember, the Fed has most control over them, these two. So you're going to want them to decrease their spending. And so what do they need to do to interest rates to cause a decrease in spending? All right, and so over here, you would want to raise the interest rates because then it becomes more expensive to borrow money, so people are less inclined to buy houses and cars and washers and dryers and refrigerators and all that stuff, televisions, on credit, borrowing the money. And also businesses are much less likely to invest. And so this is what we would call contractionary monetary policy. And this has a couple other words as well. This could be tight. Okay, tight monetary policy or contractionary monetary policy mean the same thing. So again, here's the tool bag that the Fed has. They have reserve requirements, discount rates, and securities. And so if they want to cause spending to decrease, they would take reserve requirements. And what would they want to do with reserve requirements, do you think? Hopefully you said it would raise them up. So now banks have to hold on to more money, which decreases the amount of excess reserves, it lowers the amount of money they can lend out, and that increases the interest rates. The discount rate, if you want to discourage banks from borrowing from the Fed, you would jack up the discount rate. And securities, buying and selling bonds, let's go over here. If you want, let me erase this real quick. I'm focusing on this one because the securities are what banks use. I'm sorry, the Federal Reserve uses very often. So, come on, pen. All right, so remember this is the vault. Here's cash, and here's bonds. And so this is our required reserves. All of this is excess. Remember the excess, this is also called loanable funds. This is the money that they can lend out. And so if you want to jack up interest rates, then you will go to the bank. The Fed's going to go to the bank and say, hey, you want to buy these bonds from us? And the banks would say, sure, those look like good bonds. And so they'll take part of their excess reserves and send the cash to the Fed. All right, and so let's say this is, $1 million worth. And the Fed takes $1 million worth of bonds and sends it to the bank. And so now we have, again, if this is our supply and demand for money, it's the interest rate. All right, and so if this just happened, what happened to the amount of excess reserves? It went down, so the supply of money went down, so the interest rate went up, like that. And if the interest rates go up, then people are less likely to spend money. All right, and so we would say that they would sell securities over here. All right, and remember this all gets down to what happens to the supply of money. All right, so this is the interest rate, and so with a recession, you want interest rates to go down, and so you increase the supply. With inflation, you want interest rates to go up, so you increase the supply. Let me just write that out. So if interest rates increase, there will be a decrease in consumer spending and a decrease in business investments. All right? If interest rates decrease, then there will be an increase in consumer spending and an increase in business investments. And by the way, so if those two increase, then we have an increase in aggregate demand. If both of those decrease, we have a decrease in aggregate demand. So it all comes down to the interest rates, and you manipulate the interest rates. Interest rates can be manipulated by changing the supply of money. The supply of money. Okay, and so this is our graph. So supply and demand. All right, obviously interest rates can be, or demand is demand influences the interest rate as well, but they can't control the demand as well, but they can control the supply. And so by taking it back or forth, you control the interest rates. By controlling the interest rates, you control consumption and investments. And by doing that, you control aggregate demand. And therefore, by controlling aggregate demand, you can hopefully fix the economy one way or the other. All right. So this is what's called monetary policy. Now let me just add one more thing. This is something you will see. This is really what the Federal Reserve targets, the federal funds rate. This is the interest rate banks charge one another for short, let's say, overnight loans. So here's how this works. Remember, if you're a bank, let's say you have $100 in deposits. That means at the end of the day, if the reserve requirement is 10%, then at the end of the day, you better have 10 bucks. All right, that's the law that the Federal Reserve has set, that it's got to be 10%. And so what might happen during the day, and what happens often is, what if this goes down to 8? And if you want to be realistic, put 6 or 9 zeros on here. And so if that goes down to 8, if you're the bank, then and you're sitting there at 8 bucks, you need to find $2 so you can meet your reserve requirement. I'm sorry, your reserve requirement for the day. And so you go to another bank and you say, "Can I borrow $2?" And they say, "Sure." And so they give you $2. They charge you. This is the federal funds rate. All right. And so the bank takes their $2. Now they can meet their reserve requirement for the end of the day. When the day is over, they give the other bank back $2 plus interest, and this interest is the federal funds rate. Now, not to make an overly complicated story even more so, this is what the Federal Reserve has found, that by manipulating the federal funds rate, all of the other interest rates typically fall in the direction that they want them to. So to be clear, the Federal Reserve does not officially set interest rates. All right, let me write that down because that is an important point. Federal Reserve does not set interest rates. What the Federal Reserve does is they take actions to influence the interest rates to where they want them. All right. So there is no policy where they say the interest rate today is this, but they can say, you know what, we're going to either buy or sell securities, and we can manipulate the interest rate to where we want it to be. All right. And so Right now, the interest rates are very low. To buy a house, you guys doing your projects, 30-year loan, something like 3.5%. This is extraordinarily low. The Federal Reserve has made this happen, and they're doing that because uh, they want to get people out spending money. Now, one of the problems that they've run into is that uh, if people think the economy is bad, even if interest rates get really low, what happens if they don't spend? All right, what happens if we're over here and they cut interest rates really low by using all these tools, one or all of them, and interest rates go way down, but people are like, look, the economy, just kind of worried, and so they don't go out and spend a bunch of money, you know, then this becomes ineffective. Uh, this becomes ineffective. You can't force somebody to borrow money. There's a phrase called you can't push a string, and that is you can't force people to do something like go out and buy a car or a house. All right, it's much easier to pull back spending than to force spending. So, anyways, that's the Federal Reserve. Again, make sure you are familiar with loose or expansionary monetary policy or tight or contractionary monetary policy. Actually, the other one, I know it would come to me, easy monetary policy is also this. So make sure you're familiar with this, how all these different tools work, uh, and that should be it. That is the Federal Reserve System. So until next time.